I'm joined now by a familiar face, my colleague Karen Manczko. Karen, let's take a look at how the Wespath funds performed in Q1.
Thanks, Joe, and hello, everyone. The chart on the screen shows the net of all fee performance of the individual Wespath fund composites versus their respective market indices. The first row in this chart is the multiple asset fund, which is our flagship balanced portfolio. As a reminder, this fund has a 65% allocation to equities and 35% allocation to fixed income. The funds directly below the multiple asset fund are the four core Wespath funds that comprise it. The first column on the chart showcases the first quarter net of all fee performance results. If you move your eyes to the bottom of the slide, you'll notice that the Inflation Protection Fund is the only fund that ended positively on an absolute basis in the first quarter.
So Karen, inflation remains a concern for our investors, and recent polls show it's the #1 issue broadly for Americans. So while you mentioned the topic of Inflation Protection Fund, Karen, let's switch it up and start talking about our two bond funds.
Sounds good. As you can see on the slide, the Fixed Income Fund and the Inflation Protection Fund both outperformed their respective benchmarks net of all fees in the first quarter. Despite being down 5.88%, the Fixed Income Fund outperformed its benchmark primarily because of the fund's underlying diversifying strategies, such as the Positive Social Purpose Lending Program and the fund's overweight to high-yield bonds. As I mentioned earlier, the Inflation Protection Fund was the only fund that ended the quarter in positive territory and also outperformed its benchmark net of all fees. And the reason for the positive performance in the fund is that it has a 10% allocation to commodities, which ended the quarter up 25%.
Thanks for that, Karen. So how did the two equity funds fare in the first quarter given the volatile equity markets that we've experienced so far in 2022?
That's right, Joe. The markets have been quite volatile since the start of the year, which has been due to the impact of inflation concerns, Russia's invasion of Ukraine, and the Fed's more hawkish tilt. Focusing on the two equity funds, which are the first two funds listed below the multiple asset fund in the chart. As I mentioned, these two funds comprise 65% of the multiple asset fund and were the primary driver of the quarter results, and that was stock selection by our active managers. I'm going to highlight in a moment specific companies that impacted the performance. So while the U.S. equity funds underweight to mega cap stocks, which are the largest U.S. companies, had a positive impact on the funds, as those stocks were down over 12% in the first quarter, this was offset by the poor stock selection by our active managers and the fund's overweight to small and mid-cap growth stocks. So poor stock selection by our external managers was also the main detractor for the international equity funds' quarter performance. But on a positive note, the two equity funds' allocation to private equity contributed to the fund's performance, as we saw strong results posted from this asset class for the quarter.
So Karen, we can see that the recent underperformance of our equity funds versus their benchmarks. What about performance on a longer-term time horizon?
Yeah, the reason for the one-year underperformance for the multiple asset fund has been primarily driven by manager stock selection in the U.S. and international equity funds. Also, the U.S. equity funds underweight to mega caps detracted for the 1 year, despite being a contributor in the first quarter.
Now, I know last year we showed the webinar, the 2-year perspective was helpful because the volatility quarter on quarter has been fairly high, and also because there's been a significant change in the stocks that outperform benchmarks from 2020 to 2021 and then now in 2022.
Yeah, absolutely. If we separate out that 2-year time frame, you can see that the fund's performance has been relatively in line with its benchmark.
Thanks, Karen. So how do we look relative to other balanced funds?
This chart showcases the multiple asset fund composite versus a universe of balanced funds. And the point of the slide is to showcase and measure our fund and how we look relative to other balanced portfolios and funds that are currently on the market. We're using a universe that is compiled and maintained by Investment Metrics, which is a well-known reporting provider in the investment industry. You can see by looking at the chart that the multiple asset fund performed below the median for the 1-year time horizon, but outperformed the median in the 3, 5, and 10-year time frame. So for instance, in the 10-year, the multiple asset fund outperformed over 64% of other balanced funds in this comparison.
Great, thanks, Karen. So moving on, can you tell us about the individual fund contributors and detractors for first quarter performance?
Yeah, starting with the multiple asset fund. I highlighted this on the performance slide earlier, but the primary detractor to the fund performance was the underperformance by the two equity funds, which I'll specifically highlight here in a moment.
So Karen, you highlighted that we saw some volatility in the markets in the first 3 months of 2022 due to inflation, Ukraine, and rising rates. How did this impact the performance of our funds?
That's correct. We have seen some major market movements so far this year, which have been driven by, as you noted, inflation, rising rates, and the conflict in Ukraine. This has had a negative impact on the equity market and also fixed income markets. Starting with the U.S. equity fund, the fund underperformed its benchmark by a modest 51 basis points for the quarter. Mega cap and large cap growth stocks were one of the worst performing market sectors in the first quarter. Therefore, the fund's underweight to these stocks contributed to the performance. Also, our dedicated allocation to private equity and private real estate was a contributor. The primary detractor to the fund's underperformance was our overweight to small and mid-cap growth stocks, as growth stocks struggled in the first quarter due to the negative impact the rising rates have had on this asset class. Also, the fund's active manager stock selection and information technology, specifically e-commerce and cloud-based data management security companies like Okta and Snowflake, were down 33% in the first quarter, and this had a negative impact on the fund's relative performance. Turning our attention to our international equity fund, similar to the U.S. equity fund, the international equity fund underperformed its benchmark, which was primarily driven by stock selection of our active managers, specifically investments in e-commerce and biotech. A contributor to the fund's performance was the fund's dedicated allocation to private equity. Before moving on, a question that we have been receiving from our clients is, what is the allocation to Russia? And in the International Equity Fund, it has been less than 0.5% prior to the onset of the war with Ukraine, and today it is less than that. I also want to mention that we have instructed our managers to not purchase any Russian securities in any of our portfolios.
Thanks, Karen. So let's look at fixed income performance. So the equity market is not the only market that has seen volatility, because the bond market has seen volatility as well. This has been the worst quarter in 40 years.
Yes, the bond market traditionally has been a safe haven for investors when the stock market is volatile. But this asset class has not been able to hide from the volatility we've experienced. The first quarter, as you noted, was one of the worst quarters for bonds in 40 years. And the main driver of the bond market performance has been the ongoing inflation concerns and also Fed rate hikes, which the markets are pricing in between 8 and 9 25 basis point hikes by the end of 2022. So despite negative absolute returns by our fixed income fund, it outperformed its benchmark by 67 basis points gross of fees. There are a number of contributors that we have listed on the left hand of this slide. But the primary reason for the outperformance was the fund's overweight allocation to our internally managed positive social purpose lending program, which provides affordable housing and community development in disadvantaged areas. Also, the fund's overweight to high-yield bonds positively contributed to the fund performance, along with issue selection by the fund's Core Plus manager, PIMCO. Detractor to the fund's performance includes the fund's allocation to emerging market debt, which was impacted by the increase in the U.S. dollar. Also the fund's allocation in manager issue selection and investment-grade credit, as we saw spreads tighten.
So let's look at our final fund, the Inflation Protection Fund. This fund is the only fund that ended up the quarter in positive territory. So tell us how this happened given the negative returns across both bonds and equities.
The Inflation Protection Fund has really showcased its purpose, not only last year, but as you can see this year, since inflation is a looming concern and will be for some time. As a reminder, the fund was created to protect investment portfolios against unanticipated inflation while providing a stream of income. It ended the quarter up over 1% and outperformed its benchmark by 66 basis points. The primary reason for the positive performance is the fund has a 10% allocation to commodities. Energy, metals, and agriculture have continued to surge at a historic pace and ended the quarter up over 25%. Also, relative to the fund's custom benchmark, the fund is underweight UK inflation-linked bonds, which contributed to the fund's performance. Despite U.S. Treasury inflation-protected securities and floating-rate senior loans having better returns than other asset classes, the fund's overweight to this asset class detracted from the fund's performance since it could not keep pace with the fund's benchmark, which again includes that 10% allocation to commodities. Finally, similar to the fixed income fund, the fund's allocation to emerging market inflation-linked bonds detracted as we saw the U.S. dollar increase relative to other currencies, which impacted this asset class. So as I conclude my portion of the webinar, I think it's important to remind our viewers that the US and the whole world has been confronted with another once-in-a-lifetime event. We started 2022 with the Omicron variant lengthening the pandemic even more. And when that dissipated, we were confronted with Russia's invasion of Ukraine. All of this, with now historic levels of inflation and rising rates, have created even further uncertainty, and the markets hate uncertainty. Uncertainty can cause volatility, which can be difficult on investors because of the emotional aspect. And emotions around investing can influence bad decision making. Our goal at Wespath is to remove the emotion out of investing. We continue to remain invested and monitor our investment managers and their activities daily. We are here to work with our clients to ensure that we are continuing to invest on their behalf that allow them to meet their financial goals and support the mission of their organization.
Great. Thanks for the performance update, Karen.